Today we're looking at NIO stock, which closed Tuesday's session at $7.16 US, down about 3.5%. That's a mild pullback after what's been a fairly strong few weeks for the Chinese EV maker. But the question investors are asking right now is simple. If NIO just reported record October deliveries, and analysts have been raising their targets, then why isn't the stock climbing higher? Let's break it down. NIO's Tuesday session saw some early optimism fade into broader market weakness. The major indices were down across the board, dragged lower by tech and growth names. So part of NIO's red day can be chalked up to simple correlation. When sentiment turns risk off, even good companies get caught in the downdraft. But beyond the macro picture, there's a fascinating divergence between NIO's business performance and its share price behavior. The company just announced record October deliveries, 40,397 vehicles, to be precise. That's up roughly 92% year over year. It's one of the strongest months in NIO's history, and it showcases momentum across all three of its brands, NIO, Onvo, and Firefly. Yet the stock has softened slightly this week. That disconnect is exactly what we're going to unpack. Let's start with the good news, and there's a lot of it. NIO's October figures mark a major rebound from earlier softness. Of the 40,000-plus deliveries, over 17,000 came from the core NIO premium lineup, another 17,000 from the mass-market Onvo brand, and nearly 6,000 from Firefly, which targets smaller high-end EVs. That diversification is a big deal. It means NIO isn't relying on a single model or market segment anymore. Instead, it's building a multi-tiered ecosystem, much like what Toyota or BMW do with their sub-brands. The company also confirmed that cumulative deliveries since launch have now topped 913,000 vehicles. That's an impressive milestone for a company barely a decade old. There's also momentum in production. NIO announced that its ES8 SUV crossed 10,000 deliveries in just 41 days after launch. The company plans to raise November ES8 production capacity by around 70% compared to October. Put simply, the operational engine is running hot. Now, let's turn to the analyst side. On the bullish end of the spectrum, Goldman Sachs recently raised its price target on NIO from about $4.30 to $7 even. The reasoning: improved product competitiveness and higher sales forecasts for the next several years. Their model assumes sales growth between 6 and 11% higher for 2026 through 2030 than previously projected. That's a meaningful upgrade, suggesting confidence in NIO's long-term trajectory. However, Goldman still maintains a neutral rating. In other words, they see the company executing well, but the stock price already reflects that optimism. Simply Wall Street took a similar stance this week. Their valuation model estimates NIO's fair value at about $6.18 based on discounted cash flow analysis. With shares trading around $7 plus, the stock screens as modestly overvalued under conservative assumptions. That's not a bearish call, but it explains why some investors are hesitating to chase the rally after a 50+% rebound from the lows earlier this year. Even as deliveries soar, a few storm clouds linger on the horizon. First, there's the lawsuit risk. NIO has faced volatility following reports of a legal dispute tied to intellectual property and investment agreements. These issues don't necessarily threaten operations, but they add uncertainty, and markets hate uncertainty. Second, profitability remains elusive. NIO's revenue trajectory looks strong, but margins have been under pressure for years. The company has been balancing aggressive research and development spending, factory expansion, and brand diversification, all of which are expensive. Investors are waiting for a clear timeline towards sustainable profit. Record deliveries mean little if costs stay high and pricing pressure persists. Third, macro conditions matter. China's EV market is intensely competitive. Dozens of players are engaged in price wars to gain share. That squeezes everyone's margins, even for a premium brand like NIO. And finally, there's the broader global environment. Rate cuts, inflation data, and general risk sentiment all feed into EV valuations. On a day like Tuesday, when growth stocks sold off across the board, it's not shocking that NIO was dragged down too. Let's talk about what might be happening under the surface in the stock itself. NIO has been one of the most active names in pre-market and intraday trading this week. That level of activity often attracts momentum traders and short-term funds. When the market turns red, those traders tend to hit the sell button first. So part of Tuesday's 3.5% drop might not have been fundamental at all, It could just be profit-taking after a strong October run. Over the past month, the stock has rallied from the mid-$5 range up to the mid-7s. That's a huge percentage move in a short window. A little breathing room isn't unusual. Volume data shows that the pullback came on lighter than average turnover, which supports the idea of consolidation rather than capitulation. So how do we explain the gap between booming deliveries and a falling stock price? It comes down to expectations versus reality. Investors knew the October numbers were strong. Hints had been leaking for weeks. By the time NIO officially announced them, the market had already priced in good news. When everyone expects excellence, even perfection isn't enough to move the stock higher. The only thing that moves prices then is surprise, and there wasn't much surprise here. Add in some macro weakness, lingering legal noise, and valuation debates, and you have the recipe for a red candle despite fundamentally positive developments. From a longer-term perspective, though, the story looks a lot brighter. NIO is slowly transitioning from a niche luxury EV brand into a multi-tiered ecosystem. The combination of NIO, Onvo, and Firefly gives it reach across several customer demographics. Its technology remains cutting-edge, particularly with battery swapping, one of the company's true differentiators in the EV landscape. As more stations are deployed, the convenience factor could become a strong moat against competitors. The upcoming models, improved capacity, and the fact that production efficiency keeps rising are all encouraging signs that management is executing. If NIO can convert volume growth into margin expansion, that could be the catalyst for the next leg higher. Looking ahead, the next major catalyst will likely be the company's quarterly earnings and any new guidance around profitability. Investors want to see two things. First, continued delivery growth through November and December, ideally maintaining that 40,000 plus pace. And second, clear evidence that costs are stabilizing or even shrinking relative to revenue. If NIO can deliver both, sentiment could shift quickly. Another factor to watch is global expansion. NIO's presence in Europe is small but growing, and the company has teased possible entries into additional markets. Those announcements could reignite investor excitement, especially if backed by new local partnerships or incentives. For retail investors holding NIO today, the key is perspective. Yes, the stock is down a few percent on Tuesday, but that's noise compared with the long-term opportunity. NIO's valuation remains well below its 2021 highs, when it traded above $40 per share. If management can deliver consistent profitability, the upside could be substantial from current levels. At the same time, it's fair to stay cautious. Competition in China is brutal, and the EV landscape changes fast. Execution risk is real. That's why it's important not to base decisions solely on delivery counts. Volume matters, but profits are what ultimately sustain a company. Let's summarize the key points for today's aftermarket update. NIO just delivered a record month, over 40,000 vehicles, up 92% year-over-year. Operationally, the business is thriving. Analysts are divided but generally positive. Goldman Sachs raised its target to $7, while others suggest fair value near $6 and change, indicating limited short-term upside but long-term potential. The stock's dip today reflects market-wide weakness, some profit-taking, and the fact that good news was largely priced in. The big question now is profitability. Can NIO translate growth into earnings? That will be the next decisive factor for the stock. For long-term believers, today's pullback doesn't change the story. It might even offer a healthier base for future gains. And watch for upcoming catalysts, November delivery numbers, earnings guidance, and any updates on international expansion or legal resolutions. NIO's journey is a reminder of how complex the EV market has become. Success isn't just about selling cars anymore. It's about building ecosystems, charging, software, data, financing, and brand loyalty. NIO is doing many of those things right, even if the market hasn't rewarded it today. In a year where investor focus keeps shifting between hype and fundamentals, NIO is quietly delivering tangible results. That consistency could pay off in the long run, especially once the market cycle turns more favorable for growth stocks. For now, the stock might continue to move sideways as it digests its recent rally. But beneath that surface, the company itself looks stronger than it has in quite some time. So, while Tuesday's red number might catch headlines, the deeper story is one of steady improvement, and that's often how lasting comebacks begin. Thanks for tuning in. If you found this analysis helpful, hit the like button, subscribe for future updates, And let me know in the comments whether you think NIO's record deliveries are a sign of long-term growth or just a temporary surge. Until next time, stay curious, stay informed, and I'll see you in the next video.